If every bank customer decided to check whether their money was really there tomorrow morning, the system would not survive the day. ATMs would stop working. Transfers would freeze. Not because of hackers, not because of fraud, but because banks do not work the way most people think they do. That sounds extreme. It sounds like fear-mongering, but it's actually the normal operating condition of modern banking. We're taught a very clean story about money. You work, you earn money, you put it in a bank. The bank keeps it safe. Later, you withdraw it. End of story. That explanation feels logical. It feels fair. It feels necessary. But it's also incomplete. And that gap between the story we're told and the system that actually exists explains why prices keep rising, why debt never goes away, and why financial crises feel sudden and confusing. This matters right now because money feels strange. You can earn more and still feel poorer. The numbers go up, but life feels tighter. Every few years, the economy breaks, and we're told it was unexpected. It wasn't. The system just works differently than most people realize. So let's slow this way down. No jargon, no lectures, no complicated charts. Just the actual mechanics of how banks create money, explained simply, without pretending it's harmless or evil. Imagine you're 5 years old and you're playing a game with points. These points let you buy snacks. They let you trade toys. They decide who's winning. At the start of the game, there are only 10 points in the room. Everyone can see them. Everyone agrees they matter. Now, imagine one kid in the room is allowed to lend points. When they lend 5 points, those points don't come from anywhere else. They appear. The game continues. No rules are broken. No one panics. That kid doesn't steal points. They create them. That kid is the bank. Banks did not always work this way. Originally, banks were boring. They were storage lockers. You brought gold or silver. The bank stored it. In return, the bank gave you a receipt. That receipt simply said, "We owe you this gold." Over time, people realized something important. Carrying gold was heavy and risky. Carrying receipts was easier. So instead of trading gold, people traded the receipts. The receipt became money. Then, banks noticed something that changed history. Almost nobody came to collect their gold at the same time. The gold just sat there. So banks tried something risky. They lent out receipts for gold that wasn't actually in the vault. Nothing collapsed. People kept trusting the receipts. The system survived. That moment quietly changed everything. Fast forward to today, the gold is gone. The vault doesn't matter, but the structure stayed. Modern banks don't wait for deposits before lending. When you apply for a loan, the bank does not check whether someone else has extra money sitting idle. It does not move money from one account to another. It does not unlock a safe. It creates new money, digitally, instantly. If you borrow $10,000, that money did not exist moments earlier. The bank types numbers into a system. Your account balance increases. On the other side, the bank records a loan asset. Money appears. This isn't secret. It's not illegal. It's the design. Roughly 90% of all money in modern economies is created this way, not printed by governments, created by banks through lending. Now here's the part that quietly changes everything. When you pay that loan back, the money disappears. It doesn't go to another person. It doesn't get reused. It is erased from existence. The only thing that remains is the interest. That means money enters the economy through debt and leaves when debt is repaid. There is always more debt than money. Always. There has to be. Otherwise, borrowers could never collectively repay what they owe. This is why debt never disappears. It can't. The system requires it.
At this point, people usually ask, so can banks just create infinite money? No, but the limits are not physical, they are psychological and regulatory. Banks are limited by confidence, rules, and perceived risk. As long as borrowers seem trustworthy, banks can lend. As long as people believe banks are stable, the system keeps working. When trust cracks, lending stops. Money creation freezes. The economy slows. This is why financial crises feel sudden. The money didn't vanish overnight. The lending stopped. Now, let's talk about governments and central banks, because this is where confusion explodes. Governments don't usually hand money directly to people. Central banks create money by lending it to banks, especially during crises. They lower interest rates, making borrowing cheaper. Cheaper borrowing encourages more loans. More loans create more money. Not because society suddenly produced more value, but because the system expanded. This is why inflation feels confusing. You can have more money chasing the same amount of goods. Prices rise, not because businesses suddenly became greedy, but because money became less scarce. Inflation isn't mysterious, it's mechanical. Here's the irony no one likes to talk about. We're constantly told money is scarce. There's no budget, no funding, no room for mistakes. But when the system itself is threatened, money appears instantly. Trillions of dollars, overnight, no debate. Because the real limit was never money, the limit was permission. Banks don't create money out of greed. They create it because the system depends on growth. Debt creates pressure. Pressure forces expansion. Expansion keeps people working. Working maintains trust. Stopping the system would hurt everyone, especially those with the least protection. So instead, the system stretches. More loans, more money, more debt. Zoom out, and money stops looking like a thing. It's not a pile of cash somewhere. It's a web of promises. Banks promise depositors. Borrowers promise banks. Governments promise stability. Central banks promise rescue. And you promise to keep playing. To work. To spend. To believe the number on your screen matters. Because as long as everyone believes it does, it does. But here's the question most explanations avoid. If banks create money by creating debt, and the system survives on trust, what happens when trust finally runs out? Not today, not tomorrow, but eventually. That unanswered question sits underneath modern life, quietly shaping everything we think we understand about money.